Thank you all for joining us this morning. My name is Steve McMenamin. I'm your host for today's event, which is part of the ongoing series of the Greenwich Roundtable. Our topic this morning, the US dollar, yesterday's currency or not, is our first look at what may be a seismic event in the world of financial markets. At worst, it may reveal an asset class with good prospects for making money. Our panel today is classic roundtable. 2 practitioners and 1 knowledgeable expert. Each speaker is the best athlete in his field, and I'll briefly introduce them. Ken Tropin is the founder of Graham Capital Management, a quantitative macro fund, and an old friend of the roundtable. With more than $5 billion AUM, and for the past 14 years, Graham is one of the leading managers in the business. Today, Mr. Tropin oversees Graham's quantitative research process, and he's chairman of the firm's management and investment committees. Ken is also one of those remarkable people who can pay attention to the business as well as the portfolio. Before Graham, he was CEO of John Henry, a senior vice president of managed futures at Dean Witter, and under the heading of raising the professional standards bar, he was the chairman of the Managed Funds Association, the trade group he had a key role in founding. Sitting to the left of Ken, Howard Kurz is the founder and chief investment officer of Lily Pond Capital Management, a fund focused on currency strategies. Howard is one of the rising stars in the business, so listen closely. Before that, he was the head of North American markets at the Royal Bank of Scotland, the head of currency, emerging market, and proprietary trading at NatWest. He was also the head of multi-markets prop trading at Lehman Brothers. Howard is a former member of the New York Fed's Foreign Exchange Committee, and he started his career as a currency trader in 1979. Sitting to the left of Howard, Richard Clarida is the Lowell Harris Professor of Economics and International Affairs at Columbia University. He is a global strategic advisor to PIMCO and the former Assistant Secretary for Economic Policy at the US Treasury from 2001 to 2003. Before that, he served in the White House Council of Economic Advisors under President Ronald Reagan. He is a member of the Council of Foreign Relations and the National Bureau of Economic Research, where he is director of that group's project on G7 current account imbalances. And Alan Ruskin is the moderator of the roundtable today. Alan is the head of currency strategy at RBS Greenwich Capital and a native of South Africa. He's been studying the world markets for over 25 years, and he brings a fresh outlook, on our discussion today. Please welcome Alan as he sets us up for today's discussion. Alan?
Well, good morning, everyone. As you know, we're here today to discuss the US dollar, currency of the past or currency of the future. The topic, as I read it, is deliberately vague. We want to talk about all things that relate to the US dollar. This means many things to many people. I know yesterday when I was mentioning I was going to be talking, at least or moderating on this subject, and I was speaking to an RBS trader, I said, well, what do you think this means to you? And he said, well, I think this means that the dollar is bottoming, because this is like a Time magazine cover forecasting the demise of the dollar. So that was kind of classic trader talk, kind of dramatic and decisive and short-termist. I think what we're looking at today is a desire to look at both the short-term and long-term issues. I'd like to look at certainly speakers talking about some of the cyclical issues and some of the sort of structural issues that are out there. In terms of the short term, we obviously know there are huge credit woes out there that have tended to sink the dollar. And I guess the question is whether the dollar has reached the kind of valuation levels which will actually limit its decline hitherto. Thereafter, I think there's all sorts of topics as to whether perhaps alternatively the dollar is bottoming. And I know in chatting very briefly to Ken a couple of weeks ago, there were sort of questions as to whether there's some signals for a bottom in the dollar. And I think the speakers maybe can attest to whether what sort of signals to actually look at on that score. Then in terms of some of the longer term issues, I think the US dollar is not proved to be the best long-term store of value since the fall of Bretton Woods. It's been outperformed by the likes of the Swiss franc, the yen, and gold. I think there are outstanding questions as to whether there are other alternatives looking forward, whether we should be looking at the yuan, whether we should be looking at some of the BRIC currencies as longer-term store of values, at least when one uses compound interest. As far as the dollar is concerned, we've obviously had the dominance of the dollar as a unit of exchange, and there's some open questions now as to whether the dollar will still be the unit of exchange for things like oil. And if, of course, that changes, then a lot of things change. Will the dollar still be the favorite peg for Middle East countries? And, of course, if that changes, and there are a lot of knock-on effects here, then there's some questions as to the dollar's reserve status in general. What do sovereign wealth funds do going forward? So these are some of the long-term issues. I would say this, when I looked at the title, I thought there was something actually a little bit more sinister lurking beneath it, to the extent that there's some suggestion, I think, that the US has run a huge current account deficit approaching $5 trillion on a cumulative basis over the last 10 years. And was this some sort of form of debasement? Is this something along the lines of the Roman Empire, really, where the denarius was slowly debased, really, using additional base metals employed into its silver and gold coins, really. So a very, very broad a topic there that I think we look forward to hearing our guests talk about. Ken, over to you, please.
Thank you, Alan. Everyone can hear me. First of all, let me give you a brief introduction into how both our firm and myself look at the currency markets, and I brought with me some charts that I thought you might find interesting. I asked Steve for his indulgence. We don't normally hand out things at the Greenwich Roundtable, but I do think if you're trying to understand what's happening in the foreign exchange markets, that some of the analysis that I've handed out to you will be quite interesting to look at. And he was very liberal in his response and said, "Fine, no slides in a dark room, but you can hand some stuff out." Our firm is started as a quantitative business where everything we did was based on some computer model deciding what to buy and sell in the macro markets. Over the years, maybe 9 years ago, we branched into discretionary trading, and now the firm is roughly half of our assets are traded by about 20 different discretionary traders. About half of our assets are run by something like 60 or 55 different computer models. And I think we have about 75 different sources of alpha in the firm, and about 2/3 are some kind of computer, and about 1/3 are discretionary traders. And you might imagine, with so many different trading approaches and different portfolios, we could very easily, and in fact almost on every day, we have opposing positions where some traders are betting that one market's going to go up and one market's going to go down. And so it's very difficult for me to sit in front of you today and say, well, we think exactly this is going to happen or that's going to happen, and so on. So I thought, rather than try and predict too much about what is next for the dollar, I would rather focus on what are the factors that tend to influence foreign exchange rates and show you some interesting data points in that regard. I think, before I open up a couple of these charts for you to look at, one of the things that I have seen over the most recent years, and this is true of all markets, is that the market participants will gravitate to a certain set of factors, and then they'll stop paying so much attention to those factors, and they'll pay some more attention to other key issues and market drivers. We all remember in the late 70s looking at money supply. Nobody paid attention to it now in 20 years. So there are times where all of the participants really focus on a few things, and then they seem to forget about it, and they go on to some different things. The thing that I find in the foreign exchange markets that tends to drive people's buying and selling pressures these days is interest rate expectations in the U.S. versus other countries. To the extent and this is like everything I think we all say today, these tend to be generalizations as opposed to absolute statements of fact. Generally, when people think that the United States is going to have lower interest rates in the next 3 months and 6 months and 9 months than another country, they will tend to want to be long the country whose interest rates are not going to be dropping, and they're going to want to be short the currency where anticipated rates are expected to decline. So, in my view, this is the most dominant feature of foreign exchange trading to try and understand is what do people anticipate interest rates are going to do 3 months out, 6 months out, 9 months out in, for example, Europe versus the United States. And if you can correctly predict that, very often you can have a pretty good handle on what foreign exchange rates are going to do. Of course, there are other factors. It's interesting that when you look at the foreign exchange rates of the dollar versus the yen, it's really not driven actually so much by what I just said. It's really not driven by, do we think that Japanese interest rates are going to go up versus the United States? It's actually very, very highly correlated with risk indices and fear. And so there are some different fundamentals for certain currencies versus other currencies. I would say that you have a block of currencies that are very highly correlated with people's risk appetite or lack thereof, and you have another block of currencies that are very correlated with expectations about interest rates. So if you turn to the first page of this little handout I gave you here, excuse me if the font is small, and this first chart is does everybody have this? Can everybody see it? All right? Okay. Let's go from the top line down and talk about what we've got here. The blue line at the top of this chart is what the Fed has been doing with the Fed funds target rate. So obviously over the last 4 months or so, they've been dropping that very aggressively. The green line is the U.S. dollar index, so a pretty good basket of currencies against the dollar. And obviously the dollar has declined up until, I would say, about the beginning of this year, and then it's kind of been in a trading range for the last 60 days or so. The red line is the relationship between European rates and U.S. rates. And this to me is a very, very, very telling line, because you could see the correlation between how interest rates in Europe have not gone down while interest rates in the U.S. have gone down, and what has gone down with that relationship is the U.S. dollar. So to me, it's pretty strong evidence that if you're trying to understand what's next for the dollar, one of the things you really have to pay attention to is this relationship between U.S. rate and European rates. The last line on the very bottom, the blue line, is a much more subtle data point to look at, and that's what's happening with the yield curve. And I would suggest that as the yield curve steepens in the United States, it tends to support the dollar a little bit. And I think we've seen that in the last few months. So you've seen this yield curve steepening really take off in the last 90 days, and some of the selling pressure in the dollar has subsided. The next chart, I think the heading is the increased challenge of carry trades. Probably not a very good heading. What I'm really trying to show here is the relationship between carry trades and stocks. And what you can see there is this is a rolling correlation, a rolling 12-month correlation between the S&P and carry trades. And, the carry trade is most typically characterized or identified as dollar-yen. And what you'll see here is that over the last 9 months or so, the correlation between what dollar-yen is doing and what the S&P is doing is 80%. So a big driver of what's happening in the carry trade is essentially this relationship. There's another relationship that's equally easy to understand. I didn't show it here today, but if you were to look at any of the typical risk indices that all of the investment banks produce, we have an internal one at Graham. the relationship between this and the carry trade is 85, 90% as well. One technical chart. I promise I won't get into technical trading today. But we have hit a really interesting support level if you were a technical trader. And, not too many investors are technical investors. And, sometimes we all question the efficacy of this sort of information. Nonetheless, it is a pretty important trend line that we're sitting on here. This goes all the way back to 79, looking at, I think, monthly data. So, it would say that if the dollar were to break this monthly trend line, if you believe in technical analysis, and I do, you could go down quite a bit in the U.S. dollar. On the other hand, it could be a very key level at which it bounces from. So, again, this is not predictive. It's simply saying this is an interesting thing to be aware of. Next chart, something that's, I think, interesting to see is that, if you look at an inverted chart of the U.S. dollar, or if you were to look at that green line and say this is the basket of currencies against which the dollar trades, you might notice how there's an incredibly high correlation between what's happening to commodity prices and what's happening to non-dollar currencies. So a different way of saying that is the dollar's weakness has been pretty highly correlated with the strength of commodity prices. Something that I don't think too many people in the currency markets tend to pay too much attention to, but this is a pretty high correlation to look at. Lastly, not lastly. Give me one more chart after this, I think. This next chart looks at the correlation of the volatility in the dollar and in foreign exchange rates. And what I think is really surprising, and there was almost no relationship here for a very long time up until maybe the summer of last year, and then over the summer of last year, the volatility of foreign exchange trading and the volatility of the equity markets were literally sitting on top of each other. Now, I might add that this also could be said for fixed income volatility. So when the equity markets get more volatile, so too do the other capital markets, really the point of this chart. Another technical chart, you might say, if you look at this thing, that a lot of technical traders look at Fibonacci moves. A 38% correction is a very, very key level. And what you can see from this is really that since we've seen this correction, the dollar really has been in a trading range. Again, this is not a predictor. It's simply saying that we are at a very key level here. Technical levels, again, another Fibonacci move. If you look at the last chart, if we break through what's on the left axis, 1.5, we could really go in the dollar, which tends to support that long-term trend line I showed you. So hopefully that's my last chart. Oh, no, one more. My research staff keeps sneaking in this stuff and like a virus. So this is, again, not too dissimilar, but a different time scale, looking at that euro chart going back 20 years and then looking at the dollar chart against the euro going back since 2002. Again, we're at pretty key trend line levels here and frankly holding pretty nicely above them. So, you'd need the euro to break down at current prices from, 147 or something to maybe 140 to really test this trend line. So, having said all of these things, I don't want to take too much of everyone's time this morning. My own sense of things is that in the United States, the Fed's been very aggressive in cutting rates. My chief economist believes that the Fed, if we were to look out 6 or 9 more months, we'll probably see a 2% Fed funds rate, so about another 100 basis points of easing. We know that Europe is trying to not go that way, and Europe seems to talk much more hawkishly or a bad word, but in a hawkish way about inflation. And so, it would not be too surprising to see the dollar erode a little bit if the Fed has to keep easing and the European Central Bank is not as dovish. And I think that's sort of the psychology of the market at the moment. If you think about what will happen from here, you got very weak economy in Spain, you got a weak economy in Ireland, you've got a weak economy in the UK, real estate's falling in UK. So we do believe that Europe is going to end up in a similar place that the U.S. has been in over the last 6 months. Maybe not as dramatically so, but we do think that other than Germany, a lot of Europe is actually pretty weak, and the central bank is not really focusing on that. They're really focusing on inflation. And so it would not surprise me too much to see a change in their mindset and a change in what they're doing with interest rates in Europe, to see them gradually have to do what the United States has done, and that would be very, very, very supportive of a stronger dollar. So we might see some more dollar weakness until that psychology changes, but that will be the key thing to watch. If the central bank in Europe then gets forced into saying, you know what, we're behind the curve, we've got to cut rates, which is what, if you think about it, in early August of last year, the Fed was saying, we don't have a problem, and then 2 weeks later they did an off-cycle cut. It would not shock me if Trichet and others in the European Central Bank eventually had to do something similar. So that will be a key factor to watch. So with that, Alan, I turn it back to you.
Thank you very much, there, Ken. I've played the role of currency strategist for a very long time, and the one question I always get asked is, just tell me the numbers, please. And I know, Ken, you've got a forecast which has certainly got the dollar weaker, it sounds like, in the short term, and then...
I think it's a trading range, to be honest. I would favor being short dollars, but I honestly think that there could be a good move up in the dollar if Europe eventually says, hey, we're behind the curve, we got to cut rates, because the big driver, in my opinion, current account deficit, all these other things are important, but the driver is what do people think is going to happen in interest rates.
I'm taking from Ken's view a general sense that although the underlying trends in the dollar have certainly been extremely weak of late, there's some sense at least that some topping is in the works. Would that be a fair characterization?
Let me put it to you this way. If I were trying to crystallize everything I've said, we're really at a crossroads. You've got, from a technical perspective, very, very key support levels for the dollar that if they were to be penetrated, I think you would see a fairly dramatic move down in the dollar. My own gut on this is those levels will hold, and I don't think we will see that dramatic sell-off in the dollar. And then the other thing I would say is you have to look at what's going to happen in European interest rates, and my own view there is they will gradually do they will be similarly pressed as the United States was to, even though there's these inflationary factors popping up, and yesterday we had a pretty hot inflation number, they will be forced nonetheless to rescue the economy and cut rates in Europe, and that will be very bullish for the dollar. So short term it could go down. Longer term I suspect we'll see a dollar rally.
Great. Well, I much appreciate the clarity on that one. Howard and I go back a number of years now, and I think Howard's going to tackle some of this topic from a core sort of fundamental, broad brush sort of macro standpoint. So I certainly look forward to hearing what you have to say, Howard. Thank you.
It's nice to be 50 and still be considered a rising star. I appreciate that. Our approach to currency investing is, I think, a little bit different than Ken's. We tend to take a fairly medium, longer-term look at broad investor trends. Our ideas and our investment theses are highly influenced by public policy, and we spend a good deal of time sort of mining that area to sort of discern what the preferences and what the probabilities of adjustment are and how that affects the capital markets. I think a couple very important medium, longer-term facts should be established to start with, I think that we don't view currency values as expensive or cheap at any sort of point in time. That the concept of purchasing power levels, particularly if you're a leveraged hedge fund, is really a meaningless concept. That waiting for mean reversion in purchasing power could be a decade-long process. And so we think that that is over the sort of relevant trading frame or time frame. It's not an incredibly important concept. And secondly is that I think we're really beginning to look at the whole foundation of what the dollar and single currency sort of monocurrency standard of world exchange is, and that it seems clear to us that the U.S. economy will represent a declining share of the global GDP as far as the eye can see. And if you look at projections for growth rates for the BRIC countries, for example, and where we're going to be in 2010 or 2030, or I think Goldman's predictions where we're going to be in 2050, the United States will probably be the third or fourth largest economy in the world. And so the foundation for why we have a single currency standard in the world, to me, and I think what I do agree with Ken with, is that we are at a crossroads here. And it's really not the crossroads in my mind of whether or not the euro pops above 150. It's the crossroads of whether or not the world wants to sustain and carry on with the current financial architecture that's been in place really since abandonment of the Bretton Woods. And to me, I think the case is less and less compelling. And I guess what I did is that I listed a group of facts or a group of ideas entitled, "Why hasn't the dollar collapsed yet?" I think is maybe more of a relevant question. And so I listed a few of these things. Allow me to look at my sheet here. I think probably the largest factor that's been out there supporting the dollar is the transfer of dollar assets from the private sector to the public sector. And that's happened essentially through the manipulation or the intervention policies of foreign monetary authorities trying to maintain currency competitiveness, export competitiveness for their own currencies. It started really in earnest with the Asian crisis in 1997, with the Asian currencies who very aggressively built up their dollar reserves because they were so afraid of falling into the same liquidity problem that they had previously. And people began to look at this and saying, this is not a bad idea, this kind of works. And normally, and maybe why this worked for so long, it has its roots in Paul Volcker's policies, in my mind. It goes back quite a bit, and that the world has been a tremendous beneficiary of downward sloping and converging inflation expectations, really for the last 20 years. And that's been brought about both, I think, because of strict monetary policy and sort of breaking the inflationary psychology of the 1980s. Secondly, we haven't had a super cycle up in commodities up until recently. Thirdly, I think we have to look at the advancements in technology and certainly the benefits of globalization, particularly with the arbitrage of labor, maybe more so even than products, although there seems to be cheap Chinese footwear everywhere. So obviously there's relevance there as well. Second thing is that the United States has promised, and for the most part delivered, higher real returns. United States is the rabbit in the tortoise versus the hare. And I think that the expectations, both on a real return or a real interest rate basis, of the United States delivering superior returns for slightly higher risk has supported a lot of deficit spending in the past. The third thing has been the predictability, I think, and the transparency of U.S. monetary and, to a lesser extent, fiscal policies. And I think that Alan Greenspan has gone a long way in the 18 or so years that he was in the job to creating a very predictable and what we used to call almost a train schedule of expectations. The Fed, for any of you who ever worked at the Fed or been at the Fed, actually employs a small group of analysts who study the action of financial markets in the few days prior to, on the day of, and a few days after significant economic releases, most importantly the FOMC decisions. And what they try to do is they try to measure the volatility of financial markets around those decisions, with the implication being, at least to me, with the implication being that they're trying to communicate as succinctly as possible and achieve the lowest amount of financial volatility around the release of those information. And it seems to me that we are now moving towards the other end of that spectrum, where the lack of predictability and transparency in terms of what the Fed's next move is seems to be much more difficult to determine. The fourth thing I have is the depth of the capital markets. The United States has been heretofore the largest and deepest capital market in the world, and I think is just recently being surpassed by the cumulative euro markets. And I think that what's important to note on that as well is that the credit crisis, which is unfolding, or subprime crisis, whatever you call it, has certainly diminished the appeal and the attraction of capital markets, particularly with the great uncertainty. And I think the last thing I have on here is, actually two things I have on here that's related to that, is America's ability to manufacture and sell structured financial products. When you're creating assets off of what you theoretically think are good or positive assets, for which the world has easier access, better leverage to, or a little more yield from, you're creating a positive flow of income into the United States through those products. And one thing for sure we find ourselves now is a very encumbered place in being able to sell structured financial products. The likelihood of an American investment bank selling a structured financial product to a German Landesbank right now is very, very low, I would think. And I guess the last thing is our access to inexpensive resources and energy. Again, Ken alluded to this, what I call a super cycle in commodity prices and what's going on, which I think one has to differentiate between the agriculturals and the energy. I think that agriculturals tend to move in shorter term, more mean reverting cycles, that the replacement and replenishment ability is much faster than it is for precious metals or energy. You can plant cornfields faster than you can dig gold mines. I think that our expectations that we will see, I shouldn't give you the good stuff just now, but for a taste, we're expecting to see oil at somewhere between $125 to $150 a barrel, and gold probably north of $1,200. And we don't see too many impediments to that right now, frankly. So I guess the question is that if all these things have happened, why hasn't the dollar, or what are the factors that are supporting the dollar, and have they changed here? I guess going back to the first thing, the biggest thing has been the reserve accumulation by foreign monetary authorities. And if you look at the top 10 foreign central banks, not necessarily by representing the GDP, but in terms of how their reserves have changed, that would include Russia, Singapore, obviously China, and Japan. Their reserves have increased by over $4 trillion in the last 6 or 7 years. And I guess that they've been able to do this even though they have fairly unsophisticated domestic money markets in many of these countries, and they've really not been effectively able to sterilize the amount of local currency they've been putting into their domestic economy. So if you look at actually where the monetary policies of these economies are, many of these, they're actually hyper-stimulative. China has, one could argue, 16% nominal growth and about 3 or 4 or 5% interest rates. For China to move to neutral, they would need to raise their policy rate effectively by about 1,000 basis points. It's that far off. Russia's in a similar situation. There's a bunch of countries now. If you actually look at the fastest growing countries of the world, they have negative real interest rates. So to me, I'm not particularly worried about the cyclical downturn of the U.S. economy as much as I am how we're going to come out of this. Because if you look at the fastest growing economies, and you look at what the United States is doing now, attempting to monetize its extensive debts that it's accumulated, there's a much greater likelihood in our mind that we're going to come out of this in a new inflationary cycle that's going to be very difficult and you're going to find very reluctant policymakers, particularly in the G7 countries, to attack this head on. I'm not sure it's going to be labeled stagflation, but I think it's going to be a big surprise just how fast the inflation concerns are going to switch from the deflationary concerns of present. What does this mean regarding the dollar? Well, one of the things this means is that if people's emphasis switch and the source of concern switches from a downturn in domestic demand to destabilizing inflation concerns, and certainly if you look at countries like in Russia or particularly in the Mideast, places like the United Arab Emirates, you'll see that the inflation rates are now in double digits. And these guys are attempting to link their currencies to the dollar, have intervened extensively over the last half decade and accumulated huge reserves, and are now faced with a situation where they have hyper-stimulative policies in their economy. Inflation, as you know, I think is a regressive tax on the lower incomes, that the cost of milk and the cost of foodstuffs to these people are going up to the point where they're beginning to protest in the streets, and it's becoming very destabilizing. If the common wisdom, I think, switches, and I think it could do this very quickly, from greater concerns about deflation because of the United States and being dragged down this deflationary hole and the whole coupling argument to one of price inflation, then you're going to see, I think, the different battle being fought as who can have a more hawkish posture towards inflation and who can preserve the value of their currency first. And I think you're going to see countries vying for the stronger currency rather than the weaker currency, for which the last 10 years have been more about. If that happens, you're likely going to witness some significant capital movements in the currency market, some delinking or depegging of a lot of these currencies, and a very, very significant pickup in volatility across asset prices, across asset markets. We think that there's potential for 20-30% moves in some of these places, and even at that point, it wouldn't be overpriced relative to where we think fair value would be. The market is really not prepared for that. Financial sectors have really not thought this through, and I think that the chart, I think, this one chart that Ken had in his book here, which showed, to steal some of your thunder, your research staff is bigger than mine, so. But on page 4, when he talks about this critical long-term support, I think he's spot on this. I mean, I think that this is, we are at, the last possible sort of rung of the ladder that can sort of hold this thing up. And I guess I ask myself, does the United States care that much about this, and are they doing anything in the current policy mix to attempt to make the dollar scarce? And I search hard for this because, anecdotally, and I don't know if this is proper to mention this or not, but Goldman Sachs had their global macro conference down in South Beach a couple of weeks ago, and asked all us hedge fund guys what your number 1, 2, 3 trades are, and the number 1 or 2 trade out of the entire community there was that the dollar had based and that the euro was going to go down because the European policymakers were going to follow America with easier and more accommodative policies. And I was shocked by that, frankly. I think that I appreciate the fact that the dollar has been well talked about. It's been on Time magazine. It's everybody understands it's had a very weak patch here. But I don't think these things just turn around because people decide that we've reached a certain value of fairness. I think there are real reasons why the dollar is weak. And when you look at a classic current account adjustment process, it's a multi-year process. It's a process where the savings rate of the country whose current account needs to be adjusted needs to go up for an appreciable amount of time, that a propensity to consume and to import needs to go down, and that there really needs to be a change in prices. And as far as I can tell, this really hasn't occurred yet. And so I think that, maybe we're in the summer to autumn of this process, but I actually think that there's some significant and less fluid adjustments that are likely to happen. Just anecdotally, just some facts. The U.S. Federal Reserve now has, and has for several years, the lowest foreign reserve position of any industrialized country in the world as a percentage of GDP. Any major industrialized country. I think we probably, maybe Richard knows this fact better than me, I think we have less than 1 month's cover of imports as our foreign reserve positions. Not only that, and with a little bit of hubris, the Fed had swap agreements which were open with the Bundesbank, the Banque de France, Bank of Japan, or whatever, and they allowed those swap agreements to expire in 2000 or 2001, knowing that they didn't really need them because, one, the dollar was so strong. By their own words, they were a little cumbersome to maintain, and they felt that they could be reopened at any point in time. And I believe that's true. They probably could be, and they could be refunded at any time. But it strikes me as being odd that the country whose policies and whose currency is most at stake and under the greatest amount of pressure would leave itself in this financial position willfully. I think the other issue I'd like to bring up is the decoupling versus recoupling issue. And I think that one thing we've observed since the month of perfect correlation, if you can call it that, which was August 2007, was that financial assets are increasingly moving in tandem across asset classes. And we think a big reason for that is there had been a greater and greater concentration of assets managed by fewer and fewer people. And their distribution of investments that they have tend to have either common themes or have to have some interdependence. And that the ability for investment managers to really find non-correlated investments is far less available and far less clear to them than they thought it were previously. We think that the market has now almost flipped onto the other side, where if you look at the correlations, for instance, in Japanese yen and the Swiss franc and some of these other things, they're correlating. If you do regression analysis on this, you'll see correlations of 80%, 85%, 90% in some of these things on a day-to-day basis. And the idea being is that the United States is, the real underlying thesis there is the U.S. is the only game in town. And if U.S. risks go up, therefore the risks globally are going to have to go up. I think for the initial chapter of this crisis and what we've seen, that's held true. I think for what we're going to see going forward, that's going to be less so. And I think you're going to see some of these correlations, just as the market thinks now that they really have got it 9 months later, I think they will again be sort of the generals fighting the previous war. And I think you're going to see a break in these correlations because I think we are going to see some reasonable autonomous demand from economic regions in Europe as well as in Asia and the Middle East. And I think you can look at certain currency pairs in particular. If you look at the Australian dollar, for example, even taking out the fact that they just tightened monetary policy last week or 2 weeks ago, and the currency got a little bit of a boost from that. When the equity market first took its plunge in August, the Aussie dollar fell precipitously, about 15%, down to 78 cents. Well, a week or two ago in January, we were down at plumbing those same lows after the Soc Gen affair. And if you look at what the Aussie dollar was trading, it was trading at 88 cents. It's actually 12% stronger than it was. And so, to me, the world has made an assessment. Is the world a safer place now than it was in August? If anything, I think people feel that there are more contagion in the credit space with, commercial mortgages, with leveraged credit, with sovereign credits. And I think that the ability for Australia, as an example of a currency, to sort of decouple from the American meltdown, to me, is notable. And I think it's something that you're going to see more of going forward. The Brazilian currency yesterday, as we closed yesterday, reached its all-time strongest point since its devaluations of 2000 before. So there's some material things happening in the world. I don't think the whole world is going to fall down the same sinkhole the United States. I think a European policymaker who I recently had lunch with sort of expressed it this way. He says the credit crisis in the United States is a movie made in Hollywood that's opened in Europe and soon to play in the rest of the world. And I think this is going to be felt everywhere. But this is really, and I truly believe, an acutely American problem, which will have its effects on its capital markets most acutely here. And I think this does very little to support the dollar stabilizing in the medium and longer term. I think U.S. policies are geared towards monetizing debt, towards providing as much liquidity as possible. I think that the U.S. fiscal policy is near rope's end, and I think I would actually encourage them to exhibit more fiscal flexibility, because I think this $150 billion tax cut will almost certainly get swallowed up by the increase in the price of gasoline. We think for every 1 cent gasoline goes up, it costs the U.S. economy out-of-pocket expenses about $1 billion annually. So, a dollar price in the pump at gasoline will basically completely swallow up the entire fiscal cut that the U.S. Congress has just passed. So, we think that the United States is literally, and as a pun, stuck between a rock and a hard place here. And I think that the possibility and probability of some currency decoupling and some diminished support from the public sector for the U.S. dollar is entirely possible. If there's a material dollar fall, it will almost certainly have to come more from the public sector, because I think the private sector's assets are in their exposure to the dollars has been covered over the last several years much more than the public sector.
Great, Howard. Thought-provoking and as provocative as ever. I think I certainly gained some sense that Howard thinks oil and gold are hares, right? The dollar is a tortoise at best, really. By volatility, there's a sense that I think Howard's saying that the current account adjustment process has got quite a long way to go, and that in general there's some differentiation that's occurring, and that allows for some currencies to effectively decouple, like, for example, the current favorite, the Brazilian real. Howard, before we move on, and everyone will have plenty of opportunity to ask questions themselves, I was just wondering, within the scheme of things, which are your favorite currencies? I know you didn't specifically mention the yuan, but I think that's one that could go both ways in this whole process. You mentioned that monetary policy, for example, is completely out of balance there. That might mean overinvestment and big problems for China going forward, which might mean a weaker currency, although most people feel that the productivity gains, etc., will suggest that the yuan will be much stronger and will suck Asia with it. I was just wondering where you came down on that issue.
We've sort of divided the world up into three places. The countries who are resource or energy producers and savers, the countries who are resource or energy consumers and savers, and the countries who are energy and resource consumers and dissavers. And our long positions have been in the first group, where we feel that they have, because I think there's a big bifurcation happening between positive flow of investments towards real assets and negative flow of investments towards financial assets. And so our longs have been in some of the more obvious plays like Russia, some of the Mideast countries, Norway, Australia, and Switzerland, actually. And our shorts have been in the guys who find themselves indebted to the world at the wrong time when the music has stopped. And those are places like Hungary, the United States, India now, and a couple other places. So, China for us has been much ado about nothing. It's been, just a lesson in frustration. It's China is going to Churchill Downs and betting $7 to make 10. The market, the Chinese have really succeeded in taking the speculator out of the market. They have priced in at 8% in the forward curve, in the synthetic forward curve in China. They priced in an 8.25% forward premium for purchasing Chinese renminbi on a one-year basis. And so unless you think China's going to move 20% this year with the Olympics and all the other things going on, you're betting, you're setting up a bet that doesn't have the right asymmetric skew for us as a fund. Right. We like the odds a little better scoped in our favor.
Great. Well, I know that Richard Clarida, our next speaker, has written extensively on issues like the current account adjustment process, and that is seen by many people who look at markets from a fundamental perspective as a major driver as to when the dollar might turn. Are we seeing some fundamental improvement in the current account, and is this too little too late, or is this substantial, and will this ultimately drive the turning point for the dollar going forward? Richard, over to you to discuss these things.
Well, thank you for inviting me, and I have the privilege of going last and also the pressure of saying something original, so I'll give it my best. I'd like to characterize my remarks as follows. Obviously, the dollar is the currency of the past. I think, at least for the next decade, it will be the currency of the future, but I also think the dollar is going down. So let me square those three together, because I think oftentimes the discussion is you're either in the crash landing Armageddon scenario or you're in the Pollyanna, nothing's going to happen. And I actually think the dollar will be the currency of the future, but I actually think the dollar will, on average, be declining. All right, I think the fact of the matter is, if you look at the international financial system, it's not a coincidence that there is a need for a reserve currency. Anyone who spent time on a currency trading floor or just thinks about the arithmetic of running a currency business with literally hundreds of different cross rates is that there are real efficiencies in a market that's organized to have the most liquid pieces relative to a vehicle currency. And the dollar has that role now. If you look at the BIS data, roughly 85% of all currency transactions in the world every day, and there are about 3 trillion of them a day, have the dollar on one side. And that's not a coincidence. It's also the case if you look at the exploding derivatives market. Even if you're doing an interest rate swap between Japan and Switzerland, that'll typically be done via using the dollar as the intermediate vehicle. Because there's just an efficiency that I think prevails, and it's not a coincidence that one currency plays that role. So historically it has been the dollar. After all, we did win World War II. We got to write the original Bretton Woods rules very much in our favor. And since 1973, with floating exchange rates, the dollar has continued to play that role. So I think going forward, we will have a vehicle currency. I'm not in the camp that thinks that it will be a stable equilibrium to think of a world where a third of reserves are euros, a third are dollars, a third are in British pounds. And certainly it won't be that case for daily trading in spot forward currencies or in the derivatives market. And so essentially it's going to come down to another currency supplanting the dollar, because I don't think it's a stable equilibrium to have multiple vehicle currencies. It's interesting to note, actually, Alan kindly mentioned the book that I edited for Chicago Press on G7 current account imbalances. One of the nice articles in that book, which I didn't write, but which Jeff Frankel at Harvard wrote, was actually looking at this precise question. Will the euro supplant the dollar as a reserve currency? And it's a very provocative paper because it attempts to use statistics and econometrics to answer a fundamentally out-of-sample question. But he actually comes up with what I think is the right answer and pretty robust answer. And Jeff's answer is that there is a scenario, a plausible scenario under which the dollar is supplanted by the euro, but it will take a number of predicates that are not currently in place. Essentially, what he argues is that the reserve currency country needs to be willing, both politically and economically, to absorb on a sustained structural basis ongoing current account deficits. This is what used to be called in the 60s the Tropin paradox, which is that the provider of the reserve currency on average will be running current account deficits, because those deficits will be the mirror image of the capital inflows that are required to provide the source of global liquidity to the world economy. The U.S., of course, has no trouble running current account deficits. We've done so every year but one since the Carter administration, and recently they've become substantial. Ted Truman at the Institute for International Economics estimates that the reserve currency country, whoever it is, U.S., Europe, UK, will need to be running deficits that are equivalent to roughly 3% of U.S. GDP, given the global economy. So 3% of U.S. GDP would be roughly a structural current account deficit of roughly 3% of Europe GDP, obviously a multiple of that if you're talking about the UK. I don't assess now that politically or economically Europe is in a position in which a 3% of GDP current account deficit for Europe as a whole is in equilibrium. Clearly the Spaniards do it, other countries do, but for Europe as a whole, they have been in balance since the euro was created and have been in balance really for the last 25 years. The second thing that it requires is a global financial market. Europe does not have that. Indeed, as Howard said, Europe has 12 financial markets, and they're not particularly well integrated. The tipping point, Jeff thinks, and I think it is provocative, is that were in some future time the pound to disappear and for the UK to become part of the euro area, then you actually might have the conditions that you would need for the dollar to be supplanted. You'd have the world's deepest and most innovative capital market, at least when it comes to interest rate derivatives and currencies. In London, you would be adding a pretty substantial chunk to Europe that has no problem running current account deficits, and you might have that as a predicate, but we're not there yet. So I think for certainly the investment horizon of this group, that the dollar will continue to be the reserve currency. That being said, I think the dollar will on average decline. So how can that happen? Well, it can happen for what I call the W.C. Fields reason. Recall the W.C. Fields movie when he was asked, "How's your wife?" and he said, "Compared to who?" Well, the same true for the dollar. You can think of 82 reasons why you would not want to have the dollar as a reserve currency. You can also think of 82 reasons right now why you wouldn't want to have the pound as the reserve currency. For every subprime structured finance product that was issued in New York, you had a twin that in London. You have a country in the UK with a current account deficit that's larger as a share of GDP than the US. And more or less, I think the reason why the dollar continues to be the reserve currency is there's no obvious competitor. Under a scenario where Bernanke blows it or his successor blows it, and we're back to the days of the 1970s when I was in college where you had 10% inflation, then it could happen. But I'm putting my bet that even though there will be an upward inflation pressure in the U.S., there will be similar upward inflation pressure in the UK and in the euro area. And I think over the next 5 years, all three of those central banks more or less end up with the same average inflation rate. So yes, if you want to spell a scenario where the Fed totally blows it and gives up on the incredible success of the Volcker and Greenspan precedent, then you're right, the dollar is probably doomed. But I don't see that. I don't see that scenario. Now, there are countries that historically do have better inflation performance than the U.S. Excuse me, I'm losing my voice here. And that would certainly include, say, Switzerland and Japan. But no one would seriously argue that the Swiss franc can become the global reserve currency. Obviously, the economy and the financial markets are just not at the level to support that obligation. Although there was some talk 20 years ago, remember Japan is number one. Japan has low inflation. In fact, it's negative. But certainly no one would think of the yen as being a viable reserve currency. So I think for the foreseeable horizon, the dollar continues to be the reserve currency. But as I said, the dollar will decline. Now, why will the dollar decline? Well, the dollar will decline for several reasons. One, it will decline because that will be part of the process that will bring the current account deficit down. The current account deficit is currently running now about 5% of GDP. On a run rate, as recently as 2 years ago, it was around 7% of GDP. So if you take the sort of the bottom of the current account to where we are now, and you annualize it, we've had about a 2% of GDP correction. And I remind you, this is in the context of $90 oil prices. In a coupling scenario where we have a U.S. recession where we have a global slowdown, and just today the European Union scaled back its growth forecast, then although Howard may be right that we could someday look at $120 oil, I don't think we have $120 oil in a global recession. And in fact, I think oil could hit certainly 60 or 70 in that scenario, perhaps below. Remember, as recently as the fall of '06, oil traded down from 75 down to the mid 50s, just on the concern of a downturn. So I think we may now be at the point cyclically where this is starting to bite. And in terms of the U.S. current account deficit, the interesting fact, which I've written about, is that arithmetically, all of the increase in the current account deficit from '03 to '06 was due to the oil import bill. The non-oil U.S. current account deficit basically began to stabilize in 2004 and has now declined substantially. So there's a very, very, very high elasticity of our current account to oil prices right now. I do agree with Howard and Ken that there is a very tight link now between the dollar and commodity prices, and certainly a part of that is reflecting the fact that we have a Federal Reserve under both Mr. Greenspan and Bernanke, in which the headline inflation rate has been above the core rate of inflation rate, and obviously headline inflation has a big component of oil prices. And so to the extent that the Fed is running a monetary policy based on core and not headline, that is allowing for some accommodation of these higher oil prices into the overall inflation outlook. But as I said, I think if you're looking at 3 to 5 years, I think that you will see the global central banks focusing on inflation. And I think that as an equilibrium, they will run the policies that are needed to get the inflation rates down, including headline inflation rates down to a more comfortable level. In terms of sort of a more near-term perspective, as I look at currency markets, I agree with both speakers. I think that the role of central bank reserve accumulation is a huge factor in this market. A lot of the daily trading and certainly a lot of the flows of capital that go across borders are now going across borders, driven by the currency policies of Asian and Middle East central banks. My own view with respect to China is that we're now at the point where this is no longer an issue of Secretary Snow, who I worked for, or Hank Paulson going to China and bashing the Chinese. I think it's in China's interest to allow for a faster pace of currency appreciation. As recently as '03, China had a current account surplus of less than 2% of its GDP. So it ran a huge surplus with the U.S., but ran almost an equally large deficit with the rest of the world. China's surplus in '07 could be north of 10% of GDP, and that's with $90 oil prices. So China now has this gargantuan surplus. It now has inflation rates running at 7 or 8% a year. As Howard mentioned, the Chinese are having a difficulty sterilizing those flows. Last year, for example, reserve accumulation in China was $600 billion. That is, the new flows of reserve into China were $600 billion, and only about half of that was due to the current account surplus and the FDI inflows. So roughly the other half of that was a mix of legal portfolio investment coming in and hot money trying to take advantage of Chinese equities or the real estate market. So I think China will allow a faster pace of currency appreciation. I actually think the best way to play China is not by investing in RMB because of the market. I think non-China Asia is an attractive currency opportunity. If we do get a global slowdown, it looks like probably Asia will be less affected than certainly North America or Europe, and so I don't think we have a complete decoupling. But I think, if I'm making a currency bet now on the weaker dollar for the next year to year and a half, it would probably be not against the usual suspects in the G7, because we did have a big move against the euro. We hit all-time high. We went through parity with the Canadian dollar. We went to 210 on the pound. So as far as the eye can see in the G7, we hit some key levels last year. But certainly I think the dollar will trend down this year, perhaps more so against currencies in Asia and less so against the usual suspects in the G7. So again, just in conclusion, dollar is the currency of the past. Obviously, it will continue to be the currency of the future, but the dollar will will continue to decline, although the basket of currencies against which it does decline is going to be changing depending upon the stances of policy and depending upon the global economy. But on average, over the next several years, it will continue. And on that, I will stop.
Thank you very, very much there, Richard. It seems to me as if you, in general, still believe that the so-called sort of Bretton Woods II framework kind of survives, and we have a U.S. current account that moves to a more sustainable level. Asia still tends to function in part by aggressively exporting, but there's this build-up of liquidity. They still tend to hold their reserves for the most part in dollars. One question that I had was, we've obviously seen from a reserve accumulation standpoint, there's been this glacial diversification out of dollars over time. Do you see that continuing? And if so, is it at a fast enough pace to really tend to fuel this sort of dollar decline going forward?
Yeah, very, very good question, and I think I would address it as follows. Number one, I think the current system which you and I have described, actually also in my book, not to plug my book, but plugging my book, there's a great chapter by Dooley, Garber, and Folkerts Landau, the fathers of the Bretton Woods II thesis, did a chapter in my book, and certainly one of the things that I take away from that is I think the current system will continue, but it will evolve. So I think it will evolve in several ways. You will see countries that move somewhat more of the reserves away from dollars and somewhat more into euros. I think it will evolve in China in that you'll see a somewhat faster current rate of currency, certainly a faster rate of currency appreciation than we've seen to date, perhaps somewhat faster than is priced in. But I don't see Armageddon, and I don't see a crash landing. And the reason why I don't see it is in part because the players that could bring it about are pretty few in number, and will also internalize the cost to them globally. So it's an imperfect analogy, but from the end of World War II until recently, we had a world in which the U.S. had a lot of nuclear warheads, and we could fire them, and Russia had a lot of nuclear warheads, and every day there was a risk that could lead to the end of the world, but it never happened. So the fact that there's risk doesn't mean it's a likely scenario, or not even a stable scenario, because obviously you can see scenarios. Tomorrow China could basically announce, yeah, we've got $1 trillion worth of treasuries, they're all now for sale. Okay, well, that would obviously be cataclysmic. I wouldn't want to be Hank Paulson or Ben Bernanke if that were to happen. But I can also tell you if that happened on Monday, then by Tuesday afternoon, by unanimous votes in both houses of Congress, you would have legislation that would essentially say, going forward, there are no imports from China. So, yes, there are things China can do to the U.S. that would be very disruptive, but there are also things that U.S. can do to China. We already see, much short of those scenarios, discussions right now in Congress about that. So I think for better or worse, the situation now is stable, which argues for a gradual evolution of the current system and not a destabilizing collapse. I do see the U.S. current account deficit narrowing. I would point out, again, this is sort of a nerdy fact, but it's a very important one. It is true that the U.S. in the last 5 years has run cumulative current account deficits of roughly $3 trillion. And if you'd taken my course, I don't know, Cornelia's here, she's seen it. If you take a course in international macro, and in your first lecture you'll have a result that says under certain conditions, if you run a current account deficit, your liability to the rest of the world goes up by the amount of that deficit. And yet in the U.S., in fact, our liabilities have not grown at all. In fact, they've actually shrunk. So how can you run a cumulative current account deficit of $3 trillion and yet have an international liability position that's declining, getting smaller? And the answer is because the U.S. invests its portfolio much differently abroad than foreign investors do in the U.S. And because our liabilities are dollar denominated, but because our assets are yen and euro and pound denominated, when the dollar depreciates, the U.S. on aggregate actually enjoys a capital gain. And in fact, those capital gains in recent years have been on the order of $400 to $500 billion a year, almost exactly offsetting the current account deficit. And also, the U.S. tends to hold a lot of foreign equity, a lot of foreign FDI, whereas foreign investors tend to hold a lot of T-bills. And so there's no theorem in finance that says if I own foreign equities and I'm borrowing money at a T-bill rate, that we're going to earn the same rate of return. So that's another factor that has been going on behind the scenes that has tended to be stabilizing as well.
Well, that's great. Richard, before I hand the questions over to everyone else over here, just one specific. One certainly got a message that there is at least a modicum of decoupling that's likely to occur, and I think you were suggesting by Asian currencies. I was wondering if you could maybe be a little bit more specific.
Ex-China.
Yeah. I was wondering any particular currencies or kind of basket of currencies?
I would not want to give you the specific basket here. Just to say, look at the major currencies in Asia, obviously including Singapore, Malaysia, South Korea, Indonesia, perhaps Taiwan, that all in one way or the other don't like to see their currencies move too far out of alignment with the RMB. And I think that is the best, most efficient and profitable way to play China. But again, in terms of the composition and shares in each specific basket, I'll leave that to others.
Well, thank you very much. We can now throw this open to everyone over here. I think we've had three very different perspectives on what might unfold. In general, I think one has a sense that there is at least not gross pessimism that the dollar will decline very sharply, barring, I think, perhaps some of the comments from Howard would suggest that perhaps the dollar is much more vulnerable going forward. I'd like to throw the... sorry. Please go ahead.
Sure. First I have an observation and a question. The observation is this, reading from an interesting piece, historical perspective. Since 1968, the dollar has had moved 4 bear phases and 3 bull phases, anywhere from 3 to 9 months. 3 years to 9 years. So we're talking about long swaths, and we seem to be very focused on issues around the dollar. Maybe it's because we carry a lot of these things around in our wallets, and it's going to be as emotional as well as real stores of value. So that's one perspective. But here's a question. I read recently where a number of people are talking about if the dollar gets really worse, that it'll be a current funding currency like the yen, because we'll be doing dollar carry trades into Aussies and other high yielders and commodities. Can't comment about that. And secondarily, what catalysts are out there if there's a basket of currencies? Commodities are always priced in dollars. Have been for decades. Okay, it's made of minerals as well as the oils and well baggies. What happens if there's movement away toward a basket of currencies? Is there something on the horizon?
So I think the question is what actually happens to when and if the dollar becomes a funding currency. If anyone particularly wants to take that one.
Yeah, I think you're beginning to see that happen. I mean, currencies become funding currencies usually because of forward, current, and expected interest differentials, and that if you incur a dollar liability, then your hopes are that when that liability matures, it'll cost you less to pay it back than you borrowed it for. I saw an article in the FT the other day that because of some of the gumming up of the credit markets, European issuers, it's been actually more acute in Europe that they've been not able to issue debt in Europe, and they've been issuing far more of their debt in the last 3 or 6 months in the U.S. And you'd say, at first glance, you say, well, gee, that's a good thing. That kind of proves that the United States is more solid than Europe. But if you actually think about it, if they're borrowing dollars, they're incurring a dollar liability. A high percentage of those will probably be swapped out, and covered. But I would guess when you're starting to look at, if you're a Norwegian issuer or something like that, and you're looking at 300 or 400 basis points of interest differential, or an Australian issuer, and you're looking at 500 basis points of interest differential, you might say, geez, I got a hell of a running start in this. Maybe I'll only swap out 80% of it, or 75% of it, and play with the balance. And then you're talking about a real outflow of dollars. So I think the dynamic is being set up for the dollar to actually be a funding currency. When I mentioned that point, is that, at some point, what Ken said, that chart of the interest differentials between Euroland and the U.S., it matters. And maybe it's oversold right now, or maybe it's overplayed right now, but if it sustains and widens even more, it certainly matters. I think you'll see some of that. What was the second part of the question?
Catalyst for basket of currencies on commodities, except for everything's commodity price in dollars. What catalysts are out there to price commodities in things other than dollars, baskets? Notwithstanding the Saudi view versus Kuwaiti view or other.
Yeah, I was going to say there's some stable out people like the Iranian president is advocating that. And, listen, the soon-to-be elected Russian president Medvedev has publicly said that he feels that the ruble should be a reserve currency for Eastern Europe, and that they are willing and anxious to start accepting rubles as payment for gas and oil. So when you begin increasing the transactions demand for a particular currency, people will need to, store it and accumulate it.
And Howard, what's the inflation rate in Russia?
A little high right now.
9%?
12, actually.
Yeah. Okay.
Yeah.
Anyone else? Any other questions?
Howard, you talked about depegging as one of the consequences. What are the countries you're looking at most specifically as depegging from the dollar?
Well, I think there are, sort of de facto pegs. Places like in the Mideast certainly is one of the areas of our attention, and UAE in particular, where we feel, versus Saudi, where we feel there's, one, a more acute inflation issue, and secondly, less of a political issue. The Saudis feel like there's these strong political ties with the United States, and that debasing the dollar, revaluing the currency is sort of a slap in the political face of America. And I think that's for anybody who's ever spent any time in the kingdom, that's actually a more important political issue than I think most people recognize. I think that's felt less in places like the UAE, although they are trying to move together there through the Gulf Cooperation Council, the GCC. So, but they're one of the places. But I also think there's places that have softer pegs, like Russia as an example, or some of the countries in Asia as well that have sort of floating pegs that they're not really pegged, but they're crawling pegs, and that drift a little bit. And you're essentially forced to link most of your monetary policy to the U.S. I mean, the question is who has the worst problems trying to link, because if you peg your currency to the United States, you're basically committing to linking your monetary policy to the U.S. And which countries have the greatest difficulty doing that going forward are generally the countries in this cycle, certainly, who have inflation concerns.
Thank you. Well, if I'm not mistaken, I think we're actually out of time now. So before we all leave, I just want to hand the floor back to Stephen. Thank you very much.
Thank you, Alan. Alan, quick question for you. What about South Africa? What about the Rand?
Actually, not a bad time to be talking about the Rand, because I think we've got a perfect storm brewing there. You've obviously got political transitions in the works. That's a lot of political uncertainty going forward. We've got power problems. We've got a credit cycle which is unabashedly excessive in much the same way as you've sort of seen some of the excesses in the credit cycle here in the US. You have some similarities in South Africa, and you've also had a big housing boom that I think is about to turn. So I'm someone who would like to talk favorably about the currency, but I'm afraid to say that I think actually we're going to see considerable weakness going forward.
Thank you. I know how hard that was for you. Appreciate that. Thank you very much. I'd also like to thank you all for your contributions. They have been coming in very nicely. And if you'll notice, we have a piece of quiche on your plate. We can step up the menu a little bit. But thank you for your contributions. I also want to explain the seating. I think we finally figured it out with the seating. Members of record sit on the inner circle. You know who you are. You'll get a special name tag. You're going to look in the back. If it has that special designation, that means you get to sit at the inner circle. Please tell your guests, if they are guests, that the inner circle is, or inner ring, I should say, reserved for members. After they're seated, if there's an open spot, please feel free to come up. That's not really written anywhere, so we've passed the word. I'd also like to thank Jen Anker for persuading Ken Tropin to come back after 5 years. Thank you, Jen, wherever you are. And Sammy Rabana for introducing us to Howard. And finally, Cornelia. Cornelia, are you here? Would you stand up? Cornelia is one of our interns at the Roundtable. We have a very nice program with Columbia University. Cornelia, please stay standing. Cornelia will be graduating, and she is one of the few people that's actually expressed an interest in going into the marketing discipline. So I want to say that we've had a wonderful experience with Cornelia. I'm sorry I'm embarrassing you right now, but please, we've had a great experience with all the interns from Columbia, and they've gone on to do bigger and better things in the Roundtable. Thank you, Cornelia. And finally, on March 20th, Liz Hilpman will be moderating a special session of the Roundtable. We've got a surprise for you. The title is, a fancier title than this, but basically the theme is bottom fishing. So stay tuned, March 20th. Finally, the programming committee will meet in this room shortly after we say goodbye today. And Alan has laid down the gauntlet for us. We seem to be a top of the market. We are now the new Business Week magazine. So whenever you see it at the Roundtable, it's time to short the subject, perhaps. That's the gauntlet laid down for the programming committee. Let's stay ahead of the curve. And finally, I'd like to thank Todd and RBS. Once again, RBS is showing the depth of their bench, bringing us Alan, bringing us this kind of topic. It was Ken Schuer's and Todd's idea to do this session. And please, I'd like to thank them. And with that, Todd, would you like to say anything?
Well, I think we've taken up enough people's time today. So firstly, thank you, Alan, Ken, Howard, and Richard. I found it very enlightening. Just a little perspective in terms of how we're looking at it as we review managers in which we are invested or through which we have exposure on the investing side as opposed to the trading side, which is we like both the quantitative approach as well as we like to look at people who are sort of expressing their investment views through a kind of thematic approach. And the way I think about that is sort of what's going on technically to indicate that we are at a crossroads or at a threshold. And then on the thematic side, well, what's different about this time versus last time? And taking also through that thematic view, a little bit more of a prospective view on how things might play out. I think, Paulson kind of explains it very well. In thinking about the kind of the expanding crises in terms of concentric circles around the epicenter of an earthquake, and you increasingly hit kind of out of the money or what were once out of the money options, and so I just kind of throw that out there to bear in mind that there's a lot of dispersion in opinions. There's a lot of uncertainty in policy across governments. As well as within financial institutions. And so there is a lot more to play out here and to kind of think about thematically how that flows through the various parts of the economy.
Good. Thank you, Todd. Thank you very much. And with that, I'd like to thank Ken, Howard, Rich. Good job.